When traders hear the word manipulation, they usually imagine secret institutions pushing buttons behind the scenes. But Charles Dow, writing more than 120 years ago, exposed a far more uncomfortable truth. Most manipulation is manufactured inside the trader's own expectations, not by mysterious forces. Dow wrote repeatedly that movements in the market can be temporarily distorted, but not controlled. He argued that while individuals can influence prices for short periods, no one can bend the primary trend indefinitely. That means most traders lose not because someone is hunting their stop, but because they misinterpret the natural waves of the market. Dow introduced the idea that the market moves in three forms: primary trends, secondary reactions, and daily fluctuations. What most traders call manipulation today is, in Dow's words, the violent and deceptive daily fluctuation. It's the noise that traps emotional participants. He wrote that these small movements are subject to manipulation, but that they have no ability to change the real direction of value. So when a trader gets stopped out, feels targeted, or blames big players, Dow would argue something else. They're focusing on the wrong layer of the market. He warned that traders who obsess over small movements become victims of the market's natural behavior, mistaking normal activity for conspiracies. And that misunderstanding leads to bad decisions. Exiting too early, overtrading, chasing reversals, and misjudging the real trend. Dow's warning from the 1800s still destroys traders today. The market is not manipulated against you. You are manipulated by the parts of the market you don't understand. This is where the real truth begins. When Dow discussed manipulation, he was very specific. He never described it as a grand conspiracy. Instead, he split it into two categories. 1. Manipulation of daily movements, and 2. Manipulation of individual stocks, temporarily. Daily fluctuation, as Dow explained, is where most manipulation happens because the noise is easily influenced by small orders. Large traders can cause short-term distortions, sharp dips, sudden rallies, but only for minutes or hours. He emphasized that none of this affects the primary trend, which he called the only true barometer of market conditions. In his editorials, Dow explained that professional operators often push prices to trigger reactions from emotional traders. They rely on the fact that most traders follow the crowd, not the fundamentals. But Dow stressed again and again, these operators cannot sustain any movement that goes against the underlying trend. If value is rising, manipulation cannot force a long-term decline. If value is falling, manipulation cannot create a sustainable bull market. That means manipulation is real, but not the way modern traders imagine it. It's not designed to chase you. It's a natural side effect of professionals trying to fill orders, take profits, or create liquidity. Dow ultimately believed the market is too large, too interconnected, and too value-driven for anyone to dominate for long. His message: manipulation is temporary noise, not a controlling force. Dow understood human psychology long before trading psychology became a topic. He noted that traders often blame manipulation when they fail, not because the market is unfair, but because they misunderstand the structure. In his view, most traders react emotionally to daily fluctuations, assuming any sudden move against them is purposeful and targeted. But Dow wrote that the market's short-term action is naturally irregular. Prices jump because of shifts in sentiment, order volume, and liquidity. These movements appear random, but follow patterns of accumulation and distribution. When traders don't understand these phases, they see every sharp move as a trap. Dow argued that this mindset blinds traders to the true market signals. A trader who believes the market is rigged stops learning how the market actually behaves. So instead of accepting corrections, rallies, and whipsaws as part of the cycle, they build false narratives. Dow's greatest insight here: when a trader misunderstands the normal behavior of price, they manufacture their own manipulation narrative. When modern traders hear the word operator, they imagine something cinematic: shadowy institutions, cartel-like entities, or giant players secretly hunting orders. But the operators Charles Dow described in the late 1800s were something very different and far less mystical. Dow wrote about three types of operators. 1. The manipulator, short-term. 2. The professional investor, value-driven. 3. The general public, emotion-driven. And he emphasized that none of these groups could control the market's primary trend, the main movement driven by business conditions and economic forces. The manipulator, according to Dow, was not a genius villain but simply a well-funded trader who could temporarily influence daily fluctuations. This operator's power was limited to very short periods. They could cause a sharp dip to accumulate shares or push a rally to distribute them, but these moves lasted minutes, hours, or at most a few days. Dow made it clear, their influence dies the moment the underlying value asserts itself. Then came the professional investors, banks, syndicates, industrial leaders, whose power came not from manipulation, but from understanding value and acting earlier than the public. These individuals didn't move markets through tricks. They moved markets because they understood business cycles, corporate earnings, railroad volumes, and national sentiment. Their actions shaped the beginning of trends, not because of conspiracy, but because they acted rationally before the crowd recognized the shift. Finally, Dow pointed to the general public, what he bluntly called the most predictable operator of all. Their emotional reactions created the exaggerated swings, tops, and bottoms that professionals used. But Dow insisted, the public manipulates itself far more than professionals manipulate price. His most important lesson: manipulators operate inside the noise. Professional investors operate inside the trend. The public operates inside emotion. And because value always wins over time, Dow concluded that operators can distort the surface but never the ocean itself. This understanding is the key to removing fear and superstition from trading. Once you know who truly moves price and how limited their influence is, the idea of a fully manipulated market collapses. Let me take you into a real moment from the era Charles Dow observed firsthand, one that revealed the limits of manipulation with crystal clarity. In the late 1800s, powerful railroad insiders and wealthy syndicates often tried to paint the tape. They would push prices up with coordinated buying, trigger public excitement, and then quietly sell into the enthusiasm. For a few days, it worked. Headlines reacted. Traders panicked. Price moved sharply. And on the surface, it looked like manipulation was absolute. But Dow watched these episodes carefully, and in his editorials, he pointed out a pattern that most traders missed. The manipulation always collapsed against the real trend. Every single time. One famous example involved a major railroad stock. He didn't name companies directly due to editorial ethics, but historians have linked it to Northern Pacific and other large railroads of that era. Operators pushed the stock aggressively, hoping to create the illusion of strength. The public rushed in, thinking they were witnessing a major breakout. Dow noticed something different. Volume didn't confirm the move. The averages didn't confirm the move. And the broader market trend didn't align with the sudden spike. He wrote that such movements lacked the support of general conditions. In other words, it was a surface explosion, dramatic, emotional, but hollow. Within days, the price collapsed back to its original level. Many small traders were ruined. The operators made nothing substantial. And the larger trend, driven by national industrial output, commodity demand, and real economic health, continued exactly as it had before the manipulation attempt. Dow used this moment to teach the most important truth about market manipulation. You cannot manipulate a primary trend. You can only disturb the ripples, not the tide. This example is powerful because it proves Dow's philosophy wasn't theory. It came from real market behavior. He saw countless operator pushes, yet the dominant trend always reclaimed control. And this brings us to a deeper question Dow wanted every trader to ask. If short-term manipulation is temporary, then what actually dictates the long-term movement of the market? Here's the moment Charles Dow understood better than anyone. The moment when traders, worn down by false breakouts, violent shakeouts, and sudden reversals, begin whispering the most dangerous belief in all of trading. The market is manipulated. I never stood a chance. Dow observed this psychological collapse more than a century ago. He saw traders blaming everything except their own decisions. They blamed syndicates, rail bosses, ticker games, and insiders. And while some of those forces did exist, Dow noted that the emotional reaction to them was what destroyed the average trader, not the manipulation itself. He described this moment in subtle but powerful language. When traders feel outmatched, they stop thinking and start reacting. It's the emotional low point every trader experiences. A perfect setup breaks down. A position gets wicked out by a sudden drop. A candle spikes just enough to hit your stop before reversing upward. A clear trend collapses out of nowhere, then resumes without you. In modern terms, it looks like stop hunts, liquidity spikes, and algorithmic sweeps. Yes, they exist. Yes, powerful players use volatility to fill orders. But here is the truth Dow emphasized. Traders lose not because manipulation exists, but because they cannot emotionally survive it. Dow wrote that emotional traders imagine a market moved by malice. They see personal attack where there is only natural price action. They believe the market is targeting them individually. And this belief leads to revenge trades, impulsive entries, and a breakdown in discipline. This is the darkest moment in a trader's journey. The belief that success is impossible because someone else controls the game. But Dow's greatest insight is this. The market is not against you. It simply reacts to forces larger than you. And the moment you realize that manipulation cannot overturn the primary trend, something shifts. You stop fighting shadows. You stop reacting to noise. You start aligning with the tide instead of resisting it. Every great trader has to pass through this emotional valley before they see the simplicity waiting on the other side. Now, the question is, what was Dow's breakthrough lesson that pulls traders out of this low point? Here lies the single most important truth Charles Dow taught. One so powerful, so clarifying, that it dismantles nearly every fear traders have about manipulation. No individual can manipulate the primary trend. Dow didn't say this as theory. He said it after watching every kind of insider, operator, and syndicate try and fail to bend the long-term direction of the market. He explained it like this. Manipulators can influence daily fluctuations. Big operators can influence short swings. But only economic reality can influence the primary movement. In Dow's framework, the market has three trends. Primary trend, months to years, impossible to manipulate. Secondary reaction, weeks, difficult to manipulate. Daily movements, minutes to days, easily manipulated. And here's the breakthrough. Dow taught that traders lose because they focus on the only trend manipulators can actually touch, the daily noise. When you trade inside the noise, you feel hunted. When you trade inside the trend, you feel aligned. Dow wrote that the market is a barometer of conditions. Not a casino, not a controlled trap. A barometer. A reflection of business activity, earnings, demand, supply, industrial capability, and national psychology. What does this mean? It means the long-term rise or fall of the market is not determined by tricks. It is determined by reality. No operator can manufacture prosperity. No operator can prevent a recession. No operator can freeze a bull market. No operator can stop a bear market. Dow emphasized that the operator's actions must ultimately conform to the line of value. In simple terms, the truth always wins. Even if the market moves irrationally in the short term, the long-term direction is always shaped by real forces. This lesson is liberating. You don't need to decode every spike. You don't need to fear every sweep. You don't need to imagine invisible hands behind every candle. If you've followed this journey, here's the truth Charles Dow wanted every trader to understand. The market is never truly against you. All those sudden spikes, sharp drops, and apparent manipulations, they are not personal attacks. They are the natural rhythms of a market responding to supply, demand, and value. The operators, insiders, and professional investors only influence short-term movements. The long-term trend, the tide that carries all prices, cannot be bent or broken by anyone. That's the immutable reality Dow revealed. This realization is more than strategy, it's psychological liberation. When you stop seeing manipulation as a threat and start seeing it as information, your decisions change. You stop panicking at temporary setbacks. You stop chasing reversals that aren't real. You align yourself with the primary trend, the market's natural movement, and your trades begin to flow with the rhythm instead of against it. Dow's approach teaches patience, observation, and respect for structure. He wanted traders to read the market like a map, not like a battlefield. Each fluctuation is a signal, not a threat. Each retracement is an opportunity, not a trap. And each primary trend is a teacher, revealing the real direction of value over time. So the lesson is simple, yet profound. Focus on what can't be manipulated. Observe carefully. Trust the trend. The moment you internalize this, the fear of manipulation disappears. You see the market for what it truly is, a reflection of economic reality, a moving tapestry of human behavior, and a field where discipline and observation always win. Speech balloon comment below. How has fear of manipulation affected your trading decisions? Did you hold through a temporary shakeout, or did you exit too soon? Share your story, because understanding comes from reflection. As Charles Dow would say, the market announces its intentions to those who can read it. Stop chasing the noise. Align with the trend.